Show me the money. This is the Moneyweb Be a Better Investor podcast, picking the brains of professional investors on their investment strategies, successes, and mistakes. Your host, Ryk van Niekerk.
Welcome to this week's edition of the Be a Better Investor podcast. My name is Ryk van Niekerk, and in this podcast series, I speak to leading professional investors and we talk about their investment journeys. We discuss how their strategies have changed over the years, and we also take a peek into their personal portfolios to see whether they practice what they preach. And the idea is to identify a few golden nuggets of wisdom to help amateur retail investors to become better investors. And my guest today is Craig Antonie. He is the Chief Investment Officer at AnBro Capital Investments. And he has qualifications from the South African Institute of Financial Markets, and he is a certified associate of the Institute of Bankers of South Africa, and he's also a stockbroker. Craig, thank you so much for your time. I don't know the SAIFM and CAIB SA qualifications. You know, I normally speak to CIOs who went the CA route or the actuarial route, but what are these qualifications?
Oh, hi there, Ryk, and thanks very much for having me, and thanks for the opportunity to chat with you. Well, these qualifications really spurred from the early parts of my career when I started off in the banking industry. And, although trying to get into stockbroking and portfolio management, really from the start of my working life, it was a very difficult thing to do. When one started in the game, it was really a case of who you knew, not what you knew. And coming from a background which was just, pretty average and pretty, normal in inverted commas, one didn't have many networks in the markets, and I found it very difficult to get in. So I actually did start another career in banking. And that's where the SAIFM and CAIB, or the CAIB in particular, qualifications came from, was, an initial sort of step into the banking industry. And I started my career at Standard Bank. And, whilst they obviously picked up the fact that Standard Bank did have a stockbroking division and, tried like crazy to get into that division, and then, finally was given the opportunity to do so and then made that move across. So, the qualification started off with a banking background, and then moved into the stockbroking qualification and SAIFM after that.
Yeah, that's an interesting journey. But let's go back. Tell us a bit about your background. Where did you grow up? And obviously, you went into banking, so investments weren't top of mind when you were young. So tell us about where you come from and your journey.
Grew up pretty much in Johannesburg and spent my whole life there. Went to Eden Glen High School in the East Rand. So just a sort of normal guy, but was always fascinated with the markets and investing. When I tried to, get into stockbroking, I was told by, the people I spoke to at that point that one really had to try getting to the banks to get into the industry. Now, I started off buying the old JSE handbook that one would get in the day.
The Profile Media handbook, yes.
Yes, that's right. And at the back, there was a key and a list of all the stockbrokers in the industry, for people that wanted to open up an account, and who you could contact. And I literally sent every single one of them a letter asking them for a job, and happy to start off really at the lower end of their business if I could, just to get my foot in the door. And, after sending all these letters, I only got about 3 or 4 replies, and all of them was a bit of a Dear John type letter saying, sorry, thank you for the interest, but, we're unable to help you. I then went to a recruitment officer who suggested that banks were the way to go to get into the industry, as at the time, all the big South African banks were going through a process of really sort of picking up the stockbroking, the independent stockbroking businesses. And they said that might be a way to do it. So I went that route, but ultimately started then just following a journey in retail banking. And, made friends with the people that worked at the old securities department at the branch that I worked in. Started helping them with normal client interactions where people would ultimately, walk into the branch and say, I'd like to buy myself 10 Anglo-American shares. And the branch would physically help them do that and get their share certificate, and they'd come and collect their share certificate. And, sort of started off that way, and then ultimately found a way into the Standard Bank stockbroking business all those days ago, which is probably around 1998.
Yeah, the industry has changed significantly since then. I don't know, if there are nearly as many stockbrokers left, because at that stage there was still a floor, you had to shout, then there was a semi-automated trading system, and now it's fully automated and real time. Is there still a significant need for qualified stockbrokers?
Well, in terms of JSE regulation, a stockbroker needs to be a physical or actual stockbroker, needs to be part of your business if you have a stockbroking license. That's really where the need for stockbrokers came from. And although they've been incorporated into much bigger institutions than that now, there still is a need for someone to have a physical stockbroking qualification in order to run a stockbroker per se. So, you tend to find that there are still a few of us around there, although not much emphasis is put on that qualification anymore.
Tell us about your first exposure to the investment world.
Originally, you used to watch all the movies out there, and it looked like, a very sort of romantic job where there was great success and excitement and adrenaline and all that kind of thing. And I think that's what initially got me quite interested in it. But ultimately, what attracted me at the end of the day was the idea of actually owning a piece of a company. Very much like, if you wanted to invest in a property, one could very rarely go and buy the whole house. But if you could just buy one little brick of that house, at least you had a piece of it. And that's where it started from. And, I would look around every day at the sort of products we used and the places we would go to shop at, or if we went out for dinner, where we might go. And I always wondered, how do these companies do? I mean, do they make money? Do they do well? How many people, are there in the store at the time? And ultimately that sort of garnered some interest as to how this whole industry works and how does one start a business and make money from it and all the rest of it. And that became the stepping stone into my investment journey. So I was always fascinated with owning a piece of a company that was far bigger than I could imagine anything to be, and try and participate in that company's success over time. And I was very lucky. I mean, I met a person that I started my career with at Standard Bank in the old days, and he was an old hat at the game, and he kind of took me under his wing and was very wise and helped me with sort of shaping the philosophy that a person should have as an investor, and how important it is to have a long-term view and take a big picture view of things as opposed to sort of short-term orientated stuff.
Mentoring, I think, is critical in the investment world. Who was your mentor, and exactly, what was the interaction between the two of you and the lessons you've learned?
He's still around today. His name is Tim May. And, he was a guy that, was a lot older than I was when I started, but the sort of guy that spoke a lot of sense. And when you sat down with him and you had a chat with him, you could understand where he was coming from. And the wisdom out there was significant. And some of the things that stick with me today are, some of the lessons learned with regards to facing moments of turmoil or stress, for example, which tends to happen in markets from time to time. We would sit down during these times and talk about things, and you would say, okay, well, have we done our homework around what this business does? Have we spoken to the management team? Have we looked at the balance sheet? Have we looked at the cash flows? Is the company's debt manageable? All these kind of things. Put that into context with regards to really how the company is performing relative to the share price at this point in time. And, and if the boxes were ticked and the share price was misbehaving, well, nothing we should be too worried about, and take a longer term view, which is in what we did.
In your personal capacity, when did you start to invest for yourself, and what was your very first investment?
Well, the first share I bought myself was Comair, which was interestingly enough, well, they actually bought them after the IPO. And I was quite fascinated by this idea of air travel and being able to sort of whip around South Africa quite quickly. That was the first stock I actually bought. But after that, I started getting a fascination with dividends and dividend yields. And, I liked their idea of getting paid to own shares or own pieces of companies. And that opened the world into higher dividend paying stocks and things like REITs, which is then something that became quite a big part of my portfolio. This idea of earning a dividend check while you slept kind of a thing, and, having something to replace your income became quite appealing to me. So dividends also became a pretty big part of my investment strategy.
I don't think many people, or too few people, realize the effect of dividends, especially the compounding effect if you reinvest the dividends. And today, is that still a big priority for you?
Well, yes. I mean, we now have three different portfolios at AnBro. One of them is focused on dividend investing and the compounding of those dividends. Now, the one thing that always appealed to me was being someone that came from a background which was relatively, I would say, modest. We weren't a family that had a lot of means. Getting my first job and being able to save some money became quite important to me. And then this idea of, well, having that money in savings and getting an income from it, much like you would interest on a fixed deposit per se, became very appealing. And, I had this goal very early on of trying to replace my salary check by a dividend check, with the sense then being of, well, if anything happened to me with regards to my job prospects, or if I lost my job for whatever reason, which may happen, if I had a dividend check which could cover my salary and hence my expenses, I'd be in a better off situation than most people out there. And that's really where the journey came from, and it still plays a pretty big role in my investment strategy today, and is one of the cornerstone portfolios that we have at AnBro.
Did you manage to do that, to replicate or equal your salary through dividends?
Yes, I have managed to do that, I'm happy to say. I do live a modest lifestyle though. I try to be debt-free as much as I can. Don't drive a fancy car or have things like credit card debts and things like that. With the ability to do that, it does take a lot of pressure off you as a person and as an individual. And also, if one tends to look at some of the better paying dividend companies over time, they have had phenomenal returns, not just from dividend and dividend growth, but share price performance as well. And if one looks at companies that have been able to grow their dividends at above inflationary rates over time, not only do you have a recipe for a very strong growth in your income stream, but also a pretty significant increase in the value of your portfolio, and capital growth as well. And if one looks at a few examples like that in the SA market, you could have a look at companies like Bidvest, Bidcorp, and First Rand, some of the big banks out there. There's many companies and many examples out there where growing cash flows and dividend streams have accompanied very, very strong capital appreciation. And as a result, over a long period of time, investors get the benefit of both increasing wealth and increasing cash flows, which is something that you cannot underestimate the benefit of and the power of.
Is your personal wealth invested in the portfolios you manage at AnBro?
Yes, exactly. So, 100% so. All of our investments that we have as fund managers at AnBro are invested in the three portfolios that we have. Now, how we've kind of worked over time, just so listeners know, is I had a long-term core portfolio, which was a very diversified portfolio. And what we started noticed at some point was that certain parts of the portfolio started performing incredibly well under different market circumstances. Well, I carved those portfolios out into three individual parts, which could then ultimately help investors to determine what strategy or what investment profile they would like, depending on wherever they were in the investment journey. So we have now three portfolios in the AnBro stable, and my wealth is split equally amongst all three of those portfolios. So we have the same sort of exposure to the portfolios and the stocks that all our clients and any other investor that invest in an AnBro portfolio would have.
It's a pretty common policy of especially boutique asset managers, where the managers of the fund actually invest in their own funds, because if you manage your own money, you're obviously going to try and do the best job you possibly can. Just give us a sense of the stocks within those portfolios, the most significant holdings you have, and why?
Well, in the AnBro sort of dynamic compounding portfolio, which is the one that we've sort of spent a bit of time talking about on now, and this is the dividend portfolio. Here we tend to focus on companies which are large, have long-term track records of delivery and performance in both dividends and cash flows, and these are global portfolios. So when we look at the sort of exposures there, we have big exposure to companies in the global insurance space. So if you think of companies like Munich Re or Allianz, Hanover Re, those are companies that we have fair exposures to, which have done incredibly well for us over time and still pay dividends roughly in the sort of 4 to 5% range in euros and Swiss francs. We also have big exposure to property, particularly in the UK and the USA. And our biggest exposure in the property sector at the moment is in a company called Realty Income, which is a triple net lease business in the US. We currently have a dividend yield in that one of well over 5%, and it pays us dividends on a monthly basis. So a very attractive regular cash flow, which comes in there. And then, another one of the big positions we have, is in the industrial space. And, that sits in a company called Air Liquide, which is something which, many investors I think are quite familiar with. They are sort of a serial long-term compounder, slightly lower dividend yield, around 2.2%, but it's grown consistently and very well above inflation over years. So, that would be in the dividend portfolio. I guess, some of the biggest shareholders we have there. In our unicorn portfolio, which is a blue sky high growth portfolio, that's a different animal. That portfolio is really looking at focusing on companies that are run by and managed by their founders. So, people that started these businesses that have big, hairy, audacious goals of changing the world and solving massive problems for investors. And what we found with those sort of companies over time is if they get it right, they get it right in a massive way. So this is, for example, trying to find the next Amazon or Google or Apple or whatever the case may be. In that portfolio, our biggest shareholdings are in CrowdStrike, which is a big cybersecurity business. We also have a big shareholding in Axon Enterprises and Shopify, which are high growth technology companies. And then we have some interesting exposures in the biotech industry with companies that are trying to solve major issues for people in the world. And this would include companies like Vertex Pharmaceuticals and Madrigal Pharmaceuticals. And then similar to the unicorn portfolio, we have smaller but high growth insurance companies, which, as they've shown sort of very strong compounding abilities over time. And in that space, Goosehead Insurance and Ryan Specialty Holdings are some of the bigger positions there. This portfolio, you'd probably find companies which not many people are familiar with. They are smaller, under the radar, big opportunity ahead type businesses. And then in the third portfolio is the world's biggest brands portfolio. And that portfolio focuses on companies which have obviously been around for a long time and done incredibly well. And there you'd see more familiar names. The biggest weights in that portfolio are the likes of Apple and Microsoft, Google, Amazon, Nvidia, Meta, etc. So these are companies obviously that have a big brand in the market. With that big brand comes a very wide moat, optionality to invest and to leverage the balance sheets and the like. And that's been also a very nice portfolio for investors. So you have the high growth portfolio, unicorn, which is probably the higher risk or most volatile brands, which sits in the middle as a core. And then you have the dynamic compounding, which is the most conservative.
What advice would you have for a young person entering the job market? The individual has opened an easy equities account, want to start investing, and after you look at the media out there, you will know that there are many diverse investment strategies. But say that person listens to this podcast and think, okay, well, let me follow a dividend strategy. How would you advise such an individual on how to start?
What I used to do when I started out was pick up the newspaper and read it every morning. Obviously, today things are different with technology as such, but I would read the news, try and get a handle of what's going on out there in the world and in the markets and in the companies that I'm interested in. And I think a lot of the time I would say, start off with businesses that are close to home, close to your own personal interests, and close to things that you are likely to easily understand. That allows you then to easily get to grips with what's going on within those businesses. And then, once you've decided to make a decision as to buying a particular business, I would then generally say to people, well, make a small note as to why you're doing it. Have a little journal there, write down, well, today I've decided to buy myself some shares in Apple. This is the reason why I'm doing it. And markets tend to get volatile, which they do from time to time, and you're feeling a bit nervous about that position. Go back to your notes, read why you've done it. That will probably help you feel more comfortable to deal with volatility as and when you see it, because it brings home the rationale as to why you've made that investment. The other thing I would suggest is don't look at the share prices every day. They can be volatile, markets can bounce up and down, and a lot of time, one of the biggest mistakes people make when they're starting out is they chop and change too quickly and too aggressively because things don't seem to go their way over a short period of time.
Do you still do it? Make notes on why you buy shares or sell shares?
Yes, I do. So as part of my investment process, I do that. And what I like to do is obviously go back then, over time and say, well, if things aren't working out and, share price has gone against me for some particular reason, I'll go back and I'll look at why did I do this transaction? What was it that I felt was compelling at the time and what may I have missed, which has caused the share price to fall. And sometimes you haven't missed anything. It's just really the market behaving in a way. I mean, you saw it, for example, when Trump was now elected as the new president of the States. Any sort of industry that he had come across as being sort of positively correlated with, share prices ramped up considerably. Anything which he was considered to be negatively correlated with, share prices fell considerably. Now, he hadn't necessarily done or said anything specific, but share prices had reacted in a pretty sharp and meaningful manner either way. A classic example is companies in the clean energy space. He has historically been very vocal about fossil fuel, not necessarily believing climate change and things like that. So you saw solar companies and battery storage companies' share prices literally collapse after he won. In a situation like that, you'd go back to your notes and say, well, what is going on in that industry? What is the bigger picture of the industry? Is someone like Donald Trump going to necessarily change the direction of travel, with regards to clean energy consumption and power consumption and things like that? My answer was no. So I used that opportunity to actually add to some of those shares as they fell.
Just lastly, 2 questions. What do you regard as your best investment ever?
My best investment ever? That's an interesting one. I would say probably investing in something like a company called The Trade Desk, which is a very sort of still relatively small, relatively unknown business. I first came across that business probably 10 years or so ago. And, it was a company that was shaking up the advertising industry. And it has done incredibly well over time. It was one of the first users of AI, if you like, and using technology to better send adverts to people when they looked for them electronically and online. It's been a phenomenal investment and has returned well over 1,000% for myself and for shareholders in our portfolios.
And then, what has been the worst one you've made, the one you really are not as proud of as the others?
Well, this one, it's a strange one because it was originally one of the best ones and then turned out to be one of the worst ones. And that was in Zoom. It's a company you're probably all familiar with. Now, I had originally bought Zoom a couple of months before COVID. And obviously, when COVID came through, the share price of Zoom rocketed and it went to levels which were, in hindsight, ridiculously elevated and ridiculously expensive. And as people pretty much thought we would never leave our homes again, and Zoom would be the only way we'd communicate with people. And what was originally an enormous winner for me then turned out to be an investment which has been a very significant underperformer. And that was a pretty big lesson I learned. When things get hot and heavy out there and everyone gets all excited, you still got to make sure that you're aware of what the fundamentals are. And in hindsight, I should have sold Zoom when they were at eye-watering valuations and not kept them. But being a long-term investor, I opted to stay the course. In that instance, it didn't work out. So my lesson there was don't let fundamentals drift too far from your ideals, if you like. That was a great investment, which turned out to be not so great
well,
as a result of that.
Even professional investors get it wrong. As long as your wins are a lot more significant than your losses, then you will make money and build wealth. But Craig, thank you so much for your time today and for sharing your insights.
Thank you for having me, Rick. It's a pleasure to be here and happy to chat anytime.
That was Craig Antonie. He's the Chief Investment Officer at AnBro Capital Investments.
Show me the money. That was the Moneyweb Be a Better Investor podcast with Ray van Niekerk. Thanks for listening. Catch up and listen to all the Moneyweb podcasts on moneyweb.co.za or the app. Moneyweb, your trusted source for business and investment insights.